Good morning, everybody. So, as we all know, there's a new tax act, and that's why we're all here today, to hear a little bit more about it. It has a wide range of provisions in it, touching on virtually every type of business, individuals, multinational corporations. So I'm going to touch on the things that I think are most relevant for the people that we deal with, meaning that domestic businesses, Ohio-based businesses, certainly individuals. What I'm not going to touch on are the international provisions, which tend to be fairly complicated. But if you want to talk about that after that, I'd be happy to chat. And I'm going to hit a bunch of topics, but certainly I'm not hitting everything because there is a large number of different items, some more important than others. I've picked and choose the items that I think are going to be most relevant. So we're going to talk about individual tax implications, estate and gift, corporate and business, and pass-through entities, which include sole proprietorships, partnerships, LLCs, and S-corps. All right, so the first, or the starting point is what's happening with individual rates. These rates apply for 2018 through 2025, so we have an 8-year period starting with this year. Very generally, we have a 2 to 3% rate reduction across the board, with the 37% rate having decreased down from 39.6. So top rate, 37%, formerly 39.6. There's been some change in the, when you hit these numbers from where it used to be. It was heavily negotiated, of course, and taking into account the cost to do this over time to the fisc, but this is where it ended up. So this is good news. So there's going to be some good and bad. Overall, I think it's good for business. But on the individual side, there's some gives to individuals and there's some takeaways, and we'll chat quickly about that. So what hasn't changed? So for individuals, we still have, of course, the employment taxes, payroll, FICA, Medicare. For sole proprietors, independent contractors, partners and partnerships, we have the self-employment tax. That hasn't changed. Net investment income tax is still there for higher net worth individuals that have investment income. And the capital gains tax has remained the same. We have a 15% and a 20% rate, with the break point being $479,000 in adjusted gross income. So I think what's important about this is that, just to note, is that the first three boxes there, if you get into the higher income numbers, when you add the 2.9 plus the 0.9, you get to 3.8%. So that really becomes the payroll tax on higher earner employees. Similarly, you have the same 2.9 and 0.9, which is 3.8% on sole proprietors, independent contractors, partners that get into higher earnings. So, and it's not even that high. Once you cross over $200,000, you're into that additional 3.8%. And that applies to the net investment income tax, which is where you get the 3.8%. So it's really designed to capture all income across the board and subject it to the 3.8%. However, there is some planning opportunities to avoid those taxes, which we'll chat about in a little bit. On the individual side, you've all heard we have a standard deduction increase. Joint, it is now $24,000. Single, $12,000. So it used to be $12,700 on the joint side. However, personal exemptions are gone. So that's one of the giveaways. So that formerly was $4,050 per dependent. However, there's a new $500 per dependent credit. So, and that leads us to the itemized deductions. So generally, the itemized deductions have been cut back, except for there's still charitable contributions and there's still mortgage interest deductions, although there's some haircut on the mortgage interest deduction. So the big one that people talk a lot about is the $10,000 cap on state and local taxes. So any state and local tax, whether it's sales tax, property tax, income tax, it's going to be capped at $10,000 if you itemize. The home mortgage interest deduction, all the old mortgages are grandfathered in. For new mortgages, you can't deduct interest on principal in excess of $750,000. However, if you have a home equity loan, then the interest on that is no longer deductible. So that's where we are with that. December 15th, it was the cutoff for old versus new mortgages. Another important change is miscellaneous itemized deductions are gone, or they're suspended for this 8-year period. So all of those expenses that you would have, including unreimbursed employee business expenses, tax preparation, services, attorney fees, if you had a personal matter and you hired an attorney to work on it. We see that a lot in employment litigation when an employee hires an attorney and to get an award. So actually the attorney fees would come under the itemized deduction, miscellaneous itemized deduction. So those are no longer deductible. Okay, but all of that sort of fits into this AMT concept, which is that AMT now, it's much less likely that individuals are going to be subject to AMT because there's a couple things. One is that the exemption amount has been increased to $109,000. So what that means, so AMT, for all of you that don't know, it's an alternative tax regime that is designed really to be a flat tax, and you're going to pay the higher on the two taxes, the regular tax or the AMT tax. And the AMT tax takes into account certain adjustments. So the AMT, for example, doesn't allow a deduction for state and local taxes, doesn't allow a deduction for miscellaneous itemized deductions. And so, where does that sound familiar? I mean, so that's basically what's taking place here is that you're no longer going to be subject to the AMT, but under the former law, if you had taken up significant state and local income tax deductions or property taxes, if you had itemized, you probably were subject to AMT anyways. So you're not going to be subject to AMT anymore, but you can't make those deductions. So probably all in all, for most people, it's going to be a wash because if you had taken those deductions, you probably were in an AMT position. So what's good is that there's child tax credit has been increased to $2,000 per child. Qualifying child is under 17 years of age. For other dependents, there's the new $500 per dependent tax credit. These begin to phase out once your gross income hits $400,000. So this was a big change. Formally, the phase out began around $77,000. So a lot of people that were in, that earned income at those levels just didn't get the child tax credit. So that's a nice change. So that's really sort of the tax computational piece on the individual side. Alimony payments starting in 2019 are not going to be deductible by the payor. And they're not going to be subject to income by the recipient spouse. So we have Barb Roman in the audience. Barb, would you mind just commenting on that? Barb is the head of our domestic relations practice. And again, this change it's not now, it's going to start in 2019.
So, excuse me, the answer to that is if you know anyone who is going to get divorced, do it this year. Because ultimately what we're going to have to do is readjust what becomes an award of spousal support so that it's fair to both sides. And so the recipient won't be taxed on it, but the payor will not have the benefit of lowering that into putting his income into a lower bracket. So there's going to be a lot of adjustments that are going to have to be made, and we're going to have to do a lot of planning for people who are looking forward to a divorce in 2019. For instance, if someone's getting divorced right now and they go to trial, if the judge doesn't finish the case within this year, then you have no control over what happens, I don't think, to the alimony. So there's going to be a lot of planning and fluctuation this year.
Okay, thank you. Okay, so on the estate and gift side, The estate tax exemption has been increased to $11.2 million per person. So that is applicable to individuals that die in 2018 or make gifts in 2018, and it sunsets in 2025. So again, it's an 8-year period. After 2025, the amount reverts back to 5.6, which what it is in 2017. These amounts are going to be indexed for inflation, and the estate, gift, and generation skipping tax is a 40% tax rate. So as long as you were in excess of those amounts, or I should say below the exemption amount, you weren't subject to estate tax. You only had estate, gift, or GST tax if you exceeded those amounts. So for most people, you're going to fall under that net worth amount and not be subject to estate, gift, or generation skipping tax. So that's good news. So what does this mean for estate planning? Well, with spouses, there's a combined exemption amount of $22.4 million now. And again, this applies through 2025. Once, starting in 2026, the amount reverts back, and it'll be 11.2% at that time, the combined exemption amount. Portability remains in the law. So portability is when one spouse passes away, if they don't use all of their exemption amount, the executor can elect to, for their unused exemption amount to be ported to the surviving spouse. So if one spouse doesn't use any of their exemption amount under current law, the surviving spouse would have $22.4 million in exemption amount. So that's a good thing. And what that really means is that, or it allows even higher net worth individuals to transfer everything to a surviving spouse, because the surviving spouse can make use of that exemption, and so that credit won't be lost. And I think for our what we've been recommending with our clients is that they look to use some kind of marital trust planning in the first instance, rather than sort of a traditional plan would have been fund a family trust first. So you utilize the first spouse's exemption amount with the idea of locking that value in, and so that future appreciation wouldn't be subject to estate tax. But given that the estate tax exemptions are so high, that probably doesn't make too much sense anymore, because even with all the appreciation, you're still not going to exceed these exemption amounts for most people. Certainly for really high net worth clients, that traditional planning still makes sense. But I think in the estate tax area, what we're really looking at is planning for step up in basis at death. Because when someone dies, all the property that they own gets an automatic step up in basis to fair market value. So if someone passes away with highly appreciated securities, real estate, all of that gets equal, the tax basis gets equal to the value at that time. And then so when the beneficiaries later sell the property, there may be no capital gain because their basis is equal to fair market value. So with a capital gains tax rate currently approaching 30%, it probably makes most sense to plan to avoid that capital gains tax. And so to do that, you would want to make sure that all the property of a married couple is included in the surviving spouse's estate. And for example, the marital trust will do that. The family trust, the traditional planning, probably wouldn't do that as well. And the same is true for, if you're single, the same is still true. You want to be planning for a step up in basis for appreciated assets. I think for higher net worth clients, as I mentioned, the traditional planning still makes sense. So if you've got some, and again, keep in mind that these rates revert back in 2026. So even if someone has, $10 million in net worth today, that's going to presumably grow over time. And when 2026 rolls around, they're going to be in a position where they have estate tax exposure. So you could be making gifts today to try to avoid or minimize that exposure if you're in those higher net worth positions. Okay, so IRAs, for 2017, the tax year, that was the last year in which you could elect to convert a regular or traditional IRA to a Roth IRA. And if you did that, then that required you to take into income the value of the IRA at the time you made the election. So people did that because, or were considered doing it because with a Roth IRA, all the future appreciation grows tax-free, and when you eventually take it out after you reach age 59 and a half, the distributions from the IRA are tax-free. So it was seen as a way to get future appreciation without being subject to tax, although you pay the current tax on the current value. So the planning technique was to do a current year conversion and then wait and see what happens, because you could always elect to recharacterize that conversion prior to the end, or prior to the due date of the tax return, to convert it back to a traditional IRA. So if you made the conversion and it went up in value, you would probably keep the conversion and just pay the tax. However, if it went down in value, you'd probably recharacterize it back to the traditional IRA. So all of that sort of gamesmanship with the IRA and the planning is gone, so you can't do that anymore. Although for 2017, if you made the conversion, you could still do that by the due date of the return for 2017. Contributions to traditional IRAs, you could still recharacterize them back and forth, so that still is in play. Okay, so the corporate tax rate, I'm sure you've heard a lot about this. It's gone to a 21% flat rate. So this applies to taxable years starting after 2017. For fiscal taxpayers that straddle the end of 2017, there's a blended rate that applies. And so the rate's gone down to 21%. It was formerly 34% for income up to $1 million, and then it went up to 35% for excess income. Personal service corporations, 21%. So anything that was taxed at a C corp rate is now 21%, and the corporate AMT is repealed. So that really is simplification, and as you've heard in the news, a big boon to particularly publicly traded corporations, which are all C corporations. But it doesn't really matter what size you are as a C corp. You get the 21% flat rate, and that's why I think there's businesses, whether they're family-owned businesses or mid-size, that are flow-through entities that are considering, should we be a C corp now because of this lower tax rate? And so we'll talk about that. Some more simplification, accounting methods for small business. This applies to businesses that have an average of less than $25 million in gross receipts. So it's going to apply to a fairly large number of businesses. So C corporations formerly couldn't elect to use the cash method unless they were under $1 million in gross receipts. So that's been increased up to $25 million. So the cash method, again, is seen as a more simplistic method of accounting. This is really designed to ease the burden on business owners. Similarly, there's an exemption for the requirement to account for inventories. So you don't have to do the cost of goods sold, although you still may want to do, but again, it's simplification. Unicap rules, which were fairly complex capitalization rules that required, instead of you taking a deduction for certain items, you had to include them in the cost or an inventory, and it would just really cause the deferral of that expense and accelerated income. So those rules don't apply. For construction companies, the percentage of completion method for contracts less than 2 years is no longer required. So you can use what's called the completed contract method or some other method that's permitted. So again, this is for these companies under $25 million in the construction industry. This is a welcome benefit because the percentage completion method really caused them to have to accrue income and pay tax on it, even if they didn't get paid, based on how complete the project was. So, and a lot of times these construction companies don't get paid on time, and so that was seen as burdensome. And I'm going to talk about a little bit, there's an interest deduction deferral that Companies under 25 million, again, are exempt from that requirement. Bonus depreciation and 179 expensing. So this rule allows companies to deduct the cost of really any depreciable property used in their trade or business, other than assets that have a life in more than 20 years. So things, and even if you do qualified improvements to the interior of a structure, so things that are normally considered buildings or real estate, that qualifies, and there's no limit on the amount that you can expense. So we see this potentially in acquisitions, so where a company is purchased, the buyer does a purchase price allocation to equipment, machinery, and formerly there was a 5 to 7 year depreciation life on that. Now it's all expense, so you can deduct it in the year that you pay it. So this is in place through 2022. So, and after that, the percentage gets ratcheted down somewhat. But for the next 4 years, actually the next 5 years, including 2018, this expense provision will be in place. 179 is a very similar provision. There's no sunset on it, though, so even after 2025 or 2022, it's still going to be in play, and it allows, again, for expensing. It's subject to certain limits. One thing that to keep in mind is that when you expense, you could trigger a net operating loss under the bonus depreciation, because maybe you've bought so much that it exceeded your taxable income for the year. Then you're going to have a net operating loss for that year. And that could be the scenario that I just described, where you have a company that is just purchased, so so maybe there's a short tax year for the buyer, and but they're expensing most of the purchase price because they're buying a lot of assets, a lot of tangible personal property. So you could trigger an NOL for that year. As I'll mention in a bit, or I can mention now, they've eliminated the net operating loss carryback provision. So if some of the planning used to be that you could trigger a net operating loss because of your transaction expenses and your other deductions when you acquire a business, and then carry it back and maybe get a refund for prior years, you can't do that anymore. You can only carry it forward. So that's a change. So the interest deduction limitation, this is new, and it applies for businesses that have average gross receipts in excess of 25 million. Interest is capped at 30% of what's called adjusted taxable income, so that's roughly EBITDA. So the deduction is capped at that point. I think there was a concern that there's a difference between debt financing and equity financing. If you make, there was always an advantage seen to debt financing, because when you pay interest on the debt, you can deduct it. Whereas if you paid a dividend or a distribution to the equity investor, that wasn't deductible. So there was sort of an inherent tax bias to debt financing. And I think that it's been addressed to some extent with this provision. So these highly leveraged companies, they're not going to be able to deduct as much interest. And what it's going to do effectively is cause those companies to have to pay additional tax rather than deferring it. So there's a new loss limitation. I mentioned the NOL deduction before. There's no carryback permitted. But in addition to that, the net operating loss can only be deducted up to 80% of taxable income. So even if you have a net operating loss that would otherwise wipe out your taxable income, you're still going to have to pay tax on 20% of that income. And again, the unused net operating loss just gets carried forward to subsequent years. But this sort of mirrors what happens with in the alternative minimum tax area, where an AMT loss could only offset 90% of taxable income. So the concept is we're going to limit the deductibility of losses there. And then there's an additional loss limitation that applies to individuals, which basically says that if you have a net operating loss you can fully deduct it against your business income, but we'll put a cap on $250,000 of that if you try to use it against your non-business income. So if you want to offset it against, investment gains or income or compensation or income from other sources, it's going to be capped at $250,000. Again, the excess NOL that's not used is carried forward. So this is a revenue raiser. And there's loss limitations throughout the code. I mean, we know about passive activity loss rules, where you can only deduct a passive activity loss against passive income. So this is following that same train of thought, where we're going to limit the use of losses and the deferral of income. So other business changes, I've just listed 4 additional items. The deduction for domestic production activity has been repealed. What that was, it was a 9% deduction, 9% of net income deduction for manufacturers that did manufacturing in the United States. So effectively that's gone. I mean, it's really been replaced by the reduction in tax rates and the 20% qualified business income deduction that I'm going to talk about in a little bit. So that's gone. Like-kind exchanges, you can't do like-kind exchanges anymore of personal property. They really weren't done that much to start with. The like-kind exchange area is dominated by the exchange of real estate because it's just easier to do. Personal property, there were already a bunch of restrictions on doing it, but that's no longer allowed. And the real estate has to be either held for investment or used in a trade or business. So it can't be like a vacation home. It has to be something that has an investment quality to it or use in a business. Entertainment expenses. Formerly you could deduct entertainment expenses if it had some business connection. You could deduct 50% of the cost. That's been repealed. What's been kept in place is the 50% deduction for business meals. So what's entertainment expense? What are business meals? I mean, entertainment, it's actually entertainment, amusement, recreation is the wording that's used. But entertainment is just what you think it is. If it's entertaining, really in any regard, you can't deduct it. So if it feels like entertainment, you probably can't deduct it.
It's marketing.
Yeah, that won't work. See, so, and that's it's a clever comment, but and what was said, entertainment could be marketing, but the IRS and the courts take a very dim view on that. So if it looks like entertainment, it's going to be disallowed, even though we all do that for marketing purposes, right? Relationship building, but if it falls in that characterization, it's not going to be deductible. So things like entertaining at nightclubs, cocktail lounges, theaters, country clubs, all of that sort of stuff, that's deductible, or that's not deductible. So anything that you would rent that you would consider entertaining, if you want to go rent a yacht and take your clients out, the rental cost is not deductible. So that falls under entertainment facilities. Club memberships haven't been deductible since 1993, so I just point that out. Business meals, however, if you like to go to restaurants and like to go have a cocktail with a client, then that's still deductible, up to 50%. So, and really in any context, I mean, if that's what you're doing, as long as it has a business connection, it's deductible. The thing that I see a lot of clients get caught on is that they don't keep good records. So there's a very heightened record-keeping requirement. You need to keep, if you're charging on a credit card, you should keep your credit card receipts. Usually you can get them from the credit card company. But it's also helpful to keep the receipt as well, particularly if you go to a hotel, for example, and you charge something, and it just shows that the DoubleTree, charged for some amount. IRS auditors regularly say, "Well, I can't tell what you did for that. I just see a charge by the DoubleTree." And you could tell them, "Well, I took my client out to dinner, or we were at the lounge," and they'll say, "Well, that's not good enough. I need to see exactly what that was." So you could run into those issues, and there is a very heightened record-keeping requirement. So it's always very important to keep good records on that.
So if you took a client that played golf and you bought him lunch, the golf is not deductible, but the lunch is.
That is exactly correct.
I was told years ago, I'm not an accountant, but that if you were to buy a gift card to a restaurant and pay for the lunch or dinner or whatever with the gift card, that it's considered a gift and that it's 100% deductible. Is that correct? Does anyone know if that's?
If you buy a gift card for somebody,
Technically, you're buying a gift card for somebody, but you're paying for the meal, so it's no longer 50% deductible, it's 100% because it's considered.
right, you bought a gift card and gave it to them so that they could use it at a restaurant.
Right.
So, yeah, I mean, you have to look at the purpose behind the gift and the relationship between the two parties. So if you're giving it to a customer, I mean, it could be a rebate, right? It depends really what the context is. You're actually giving them something of value. It could be a gift, though, that's non-deductible. So there's not a quick answer to that one.
Isn't there a $25 per year per person gift limitation?
$25 per person. I'm not 100% sure on that. So let's just move on. We're getting kind of late here. Qualified equity grants. So this is a new rule that applies to non-publicly traded corporations. And it's really allows, it's for stock grants and stock option grants, and it permits the deferral up to 5 years when those would otherwise be includable in income, and the stock options would be includable upon exercise of the option. The stock grants are taxable when they vest. I don't see a lot of usage of this at this point, except for maybe really early stage companies, because that last bullet point requires that 80% of the employees receive these grants, sort of on similar terms. So I think it's going to be really cumbersome to use this. Carried interest for financial services. Basically, they've been trying to deal with carried interest for a long time. And if you're in the financial services business, like you run a hedge fund or you create a fund that's going to buy a real estate portfolio, that profits interest or carried interest is not going to be entitled to long-term capital gain unless you have a 3-year holding period now. So that's the way they dealt with that. Pass-through qualified business income deduction. So this is the corollary to the 21% rate reduction for C corporations. Effectively, what you can do is if you're in a business and you're a qualified business, you can exclude 20% of the income from that business from tax. So that's a big net rate reduction. It does exclude investment income and capital gains, so it's really just operating income that we're looking at. The 20% deduction is determined at the owner level, so you're applying it at the partner or shareholder level. It gets reported on the 1040, but it's not an itemized deduction. So do you have a qualified trade or business? Any trade or business is qualified except for two. One is if you are in a specified service business or you're an employee. So employees, for example, can't exclude 20% of their salary or wages under this rule. What's a specified service trade or business? If you're in the business of health, law, accounting, actuarial science, performing arts, consulting, the list goes on and on. There's that second bullet point, there's a bit of a catch-all, I would say, which is if you're in any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees or owners, then that's, and there's been a lot of talk about what does that mean exactly, because it's a little bit vague. But I think what it all boils down to it, if the principal asset is really the expertise of the employees or the owners versus some kind of, capital assets or facilities or intellectual property, then I think you fall within this group. But if you can point to things like we have some trade secrets that create value, or we have a proprietary methodology or technique that we deliver value to on our clients, I think you could avoid this. Okay, so, and even if you're in a specified service business, the ones I mentioned, accounting, law, medicine, that for lower income taxpayers, you could still come within the 20% deduction. So there's a general carve out for individuals that have $315,000 of income on a joint return, and that phases out between $315,000 and $415,000 of taxable income. So if your taxable income exceeds $415,000 and you're a partner in a law firm, you're not going to be entitled to a 20% deduction on your allocation of income from the partnership. However, if that same partner had $315,000 of taxable income on a joint return, they would be entitled to that 20% deduction for their partnership allocation of income. So that's how that difference applies. For people that have income above those thresholds that I just mentioned, there's an additional requirement that to take the 20% deduction, you have to have employees at the business, and the employees basically have to be double the amount, the wages that are paid have to be double whatever the deduction amount is, the 20% deduction amount. So, and then beyond that, there's a further rule that says if you don't have that many employees, but you have a lot of capital investment, we can take 25% of your wages that are paid plus 2.5% of your capital investment, and then that'll be the threshold that needs to be met. So we'll skip. All right, so here's an example. And this example is a little bit complicated, but let's just take a operating company LLC. It has some capital investment, but maybe not a lot. Question is what taxes can we plan for to minimize the tax liability of the owner? So we have an owner and a spouse at the top. We have our operating company in the form of an LLC, which is taxed as a partnership. And it's a partnership because the owner has 98% of it, and there's a management company that we've created, which is another partnership, that owns 2%. So the assumptions are that we have $1 million of net income at the LLC. We have employees that their total wages are at least $400,000. The LLC's business is not a specified service business. And what's the amount of the qualified business income deduction? Well, it's going to be 20% of the $1 million of net income because we've met the wage threshold requirement, because our wages are at least double what the deduction is. So we can deduct the full amount of the $200,000, and the net income or to the owner is going to be $800,000. Okay, so that's how that works in that context. Now, why did we set up the management company? Well, we set the management company up because there's other taxes that are mentioned there, which is the net investment income tax, and it's really the self-employment tax that we're trying to plan around, because, as I mentioned, that's that 3.8% tax, and on $1 million, 3.8% is $38,000. So maybe it makes sense to annually. So maybe it makes sense to try to avoid that, and we do that by really creating two classes of interest. The owner has sort of a limited partner interest, so they're not, as the owner, they're not entitled to do anything directly for the LLC other than receive distributions. The management and control is vested in the management company, but that only owns 2%. So the 2%, presumably, is the only piece that's subject to self-employment tax in that scenario. Okay, so that's why that's done that way, and that's why that piece is there. So another example, this is where, let's assume we have our LLC is really a real estate LLC that owns an apartment building. Again, the LLC has $1 million of net income. The original cost of the apartment building is $10 million. The LLC has no employees. It's just, or maybe has one or two, but just assume it has no employees, so there's no wages. So what's our qualified business income deduction limit? Well, it's 2.5% of our original investment, which is the 10 million. So the cap on the deduction is the $250,000. Since our 20% amount is below that, we can deduct the full amount of the qualified business income deduction. Okay, so that illustrates sort of the two different paradigms and how those limitations work. It's really, if you meet the wage, if you have enough employees, you're going to be fine. If you don't have enough employees, do you have enough capital investment to utilize the deduction?
That's significant in real estate and
Right.
that's huge.
Right. Right. Donald Trump likes that. But there's a lot of real estate investors that like that. And it doesn't just apply to real estate. It applies to, it's really a fairness question, because if it's service versus capital intensive businesses. Some businesses have a lot of employees, some don't, but they have a lot of capital investment. So it's designed to be, to provide some equality depending on what your business makeup is. So yeah, we shouldn't be unfair about it. So when you're looking at choices of entity, what are we really looking at? We're trying to figure out what the effective rate is going to be, because everyone wants to get the lowest effective rate possible, pay less tax. So if we set up C Corp versus pass-through, I think these are the two paradigms you want to look at. Are you going to make a C Corp election, or do you keep an S Corp or a partnership? So the way these rates work is that on our income, so this is on operating income, we have, of course, a 21% C Corp rate on that income. But if our goal is to not only earn the income, but actually get it to the owners, the shareholders, we have to distribute it out for the corporation. Well, C Corps are subject to what's called double tax, because the dividend then is further taxable. So after we pay our corporate tax, we have money left over to pay the dividend. That's subject to an effective rate of 15.8%, because I've already deducted my corporate tax. And then the dividend in turn is subject to a net investment income tax, and then there's Ohio tax. So I end up with a 43.8% on that dollar that I earned by my corporation to get it to my shareholder. So I'm left with, of that dollar, 56.2 cents. So if I use a pass-through, S Corp or LLC, there's no corporate tax and no dividend tax. It's taxed directly to the owner. If I assume the top rate currently, 37%, however, I get my 20% deduction. And my Ohio tax, there's a thing called the Ohio business income deduction, which effectively puts a cap for business income at 3%. And moreover, the first $250,000 of business income is exempt in Ohio. So it's really a fantastic business income benefit. But I've assumed a 3% rate, so we end up with a 32.6% rate. Now, I haven't put in the flow-through entity, the self-employment tax, which could apply depending on how it's structured. But that would only then take it up to 36.4%. So I'm still far below the C Corp. So operating cash flow, if the goal is to get the money to the owners, pass-through looks like it's still a good deal. However, if I'm thinking that I want to reinvest my earnings, or maybe I have a bunch of debt that I've incurred through borrowings to build buildings or make investment in my business, then as I pay down the principal of that debt, I don't get a deduction for it. So it creates what's called phantom income, because I have to report the income, but I don't get a deduction for principal payments, so I have to pay tax on that income. I'm building equity in the business because my debt's getting reduced, but I'm not actually seeing any cash. It's going to pay down the bank or the lender. So how does that look? So with the corporate tax, again, I'm paying 21% on that income, but then I'm using it to reinvest in the business or to pay down debt, so there's no distribution. So in this scenario, it looks like if that's sort of the business plan with the cash flow, that the C Corp has a clear advantage, right? So you got to kind of think about what you're doing when evaluating these prospects. Now the C Corp at some point is going to turn around, which is I'm eventually going to want to get some money out of the business, right? I mean, I'm not going to keep paying down debt because presumably at some point that's going to be paid down, or I would have made enough investment and there's going to be enough earnings to make distributions. I think in that scenario, if you're eligible, you could make an S election. So then you could convert it to a flow-through entity. There's eligibility restrictions on S corporations, but that is something to look at if you have an individual owner of a C Corp that fits that model. So the service business, if we're a non-specified service business, what does that look like? Well, in this scenario, C Corps traditionally that were closely held, because if they wanted to get money out to the owner, they traditionally did it by deducting it through compensation. So I've assumed that in this scenario. So you can see I'm not paying a corporate tax because I'm assuming most of the net income is being deducted as compensation to the owner. And there's issues with whether or not you're paying too much comp and it's excessive compensation and not deductible. But let's assume we're within the realm of fairness there. So in this scenario, when you boil this down, the flow-through entity still has an advantage because I'm entitled to that 20% qualified business income deduction, whereas compensation, as I mentioned before, is not. So I think that's the real difference in these two. So if that's the model, you're a service business, but you want to kick out the money to the owner, you might want to think about a flow-through entity as the better one. The specified service business, this is accounting, law, health, all the ones that we listed there. That qualified business income deduction goes away, so you can see the rates are much closer. The difference here is, however, is that the Ohio business income deduction, right? It's the 5% versus the 3%. So I still end up with a savings in a flow-through entity because of the way the Ohio tax rules work. All right, and then we always have to think about choice of entity. You have to be forward-thinking because eventually you're going to want to sell, right? There's going to be an exit strategy, presumably. Certainly you can give it away to the next generation. You can hold it until someone dies. But ordinarily you would take into account what happens on sale when figuring out what makes sense from a structure today. So here we can see that the business sale doesn't work that great if you're a C Corp, because if the company is appreciated substantially in value, you've built up reputation, goodwill, you have a thriving business, you're going to get paid some multiple of EBITDA, and so it's your exit plan. But in most cases, buyers want to buy assets, right? They don't want to buy stock because they don't know necessarily what are the unknown liabilities. There could be contingent claims. So they want to have a clean transaction. So they're just going to buy assets, and they're going to really specify what liabilities they're going to assume. So from a risk standpoint, the asset sale is by far the way deals are done more often. The other piece of that is that the buyer can write up the value of the assets, and as I mentioned before, get the bonus depreciation, or can otherwise amortize the cost. If it's goodwill, they can amortize. So they're going to get tax deductions. So that represents value. So there's strong reasons why an asset deal is done. So if we assume an asset sale exit, we're going to have the 21% rate at the corporate level. Again, we're distributing out the sale proceeds because this is an exit. We have the dividend tax, and so on and so forth. We end up with our 43.8% rate on the C Corp. With the flow-through, as you can see, there's much lower rates because, as we talked about, there's the 20% rate on capital gain. If you sell real estate and there's some depreciation recapture on the real estate, it's subject to a 25% rate on the recapture. And if there's tangible personal property depreciation recapture, it's subject to a 37% rate. Generally, however, you're going to be able to avail yourself of that 20% rate. And then you can also, if you're an Ohio resident, you could utilize the Ohio income tax deduction. And so So on exit, the flow-through entity works a lot better. So I think overall, as I look at all this, the only scenario that I think makes sense for C Corp is where we were talking about the reinvestment of the cash into the business or the pay down of significant debt, because I can do all of that sort of, I can have all that phantom income taxed at a 21% rate. And then hopefully I can structure it so I can do an S election at some point in the future when I want to begin to take cash out. Okay, so I just have that last slide with some additional thoughts, but it really captures what I talked about already. And that's all I really have. I'd be happy to, I know we got started a little late, so if there's any questions, I'd be happy to take them. Yes?
I think it's in this slide sort of, but you run short on time, so you don't want to get into it too much. But if you're an S Corp, you got one owner who's currently getting some W-2 income and a significant chunk of it as distribution income, is there any caution or warning you would tell that person if they want to significantly cut their W-2 income so they can get the 20% deduction on more of a chunk of the income?
All right, so the question is, if you have an S Corp, and there's a lot of S Corps, there's a requirement that you pay the owner reasonable compensation. So that has to be run through payroll, and you get a W-2 for that. So, and normally that wasn't that big of a deal. It was really just that compensation piece was subject to payroll taxes. Now it's a bigger deal because the compensation piece is not entitled to the 20% qualified income deduction, whereas the net income, the other net income that's otherwise distributable is. So it's going to create an incentive to push down compensation to the owner as much as possible and increase the net income because of that 20% deduction. So, let's assume that you were paying yourself like 100,000, 150,000, or so, and you want to drop it down to like 25,000, right? I mean, it's a little bit troubling. I think at the end of the day, what the government looks at is what is the marketplace value of those services at, and they're traditionally looking at like statistical data. So I would suggest that you have statistical data, and there's compensation studies that are available on the internet that you could look at and sort of see a range of what's reasonable for what they do. So, you have compensation ranges by occupations. I'd go through that and I'd have 2 or 3 of those studies and say, and you could take the lower end and I'd say this is what we relied on. And
That's where we are. There's a company called Fazio that delivers individual reports for occupation and assessment.
right.
Simple, third-party information.
I mean, the other thing that it's a little bit more complicated, but what you could do is do a multi-tier structure where you take the business and you actually flip it into an LLC. Keep the S Corp in place as the holding company, and you can do it just by, making certain filings with the government, and then issue a profits interest from that LLC to the owner, which would have the effect of pushing more of the income to the owner and allow for the qualified business income deduction. So there's ways to address that depending on the situation and what makes sense in the context to kind of put some downward pressure on the compensation and boost the amount of the qualified business income to the owner. Yeah.
I was told that real estate investment trust income, which that previously wasn't taxed at the corporate level, is distributed as ordinary income and taxed as ordinary income. With this change in law, it's now going to be treated as dividend income and taxed at the 20% rate. Is that correct?
I think what's happening with that is I thought that for REIT distributions that they're entitled to the 20% qualified business income deduction. I thought I read that. That's not something I covered though. So I could get back to you on that though. Okay. Anything else? All right, well, thank you very much. If you have any questions, if something occurs to you later, feel free to contact me. All right, thanks.